How prices are determined. The price of lending is determined by the market and is one of the key areas of competition as businesses choose where to place their business or switch banks. Banks that overprice will lose business, while those that underprice will not be able to sustain their operation. There's a lot of comment in media at the present time around an increase in the price of funding, but there's little understanding about the key drivers behind how banks price lending. These are essentially three: the cost of funds, the cost of risk and capital, and administration costs. Let's look firstly at the cost of funds. In order to lend money to businesses, banks need to attract funds from depositors by paying them interest. They also need to aim to hold deposits for similar lengths of time as the term loans are financed. For this reason, many institutions must pay higher interest rates for deposits. Costs of capital and risk. For every loan a bank makes, it must set aside capital to ensure the bank remains solvent and depositors are secure, even if that loan isn't repaid. To ensure the confidence and security of savers, all banks around the world are currently being asked to hold higher levels of capital than has been seen in recent years. There is a cost to holding this capital, and as banks have increased the amount set aside, the cost has risen along with it. The capital that a bank needs to hold reflects the probability that borrowers will not be able to repay and the loss that a bank would experience. This assessment is based on the bank's data and experience and is constantly reviewed by the bank's regulators. If a borrower's probability of default increases or the value of security falls, for example, a decline in property values, the bank would need to hold more capital. The cost of that increased capital will be reflected in the price of borrowing. Risk-reflective pricing enables higher risk but still viable businesses to access finance, while lower risk and well-managed firms get the benefit of lower cost funding. Pricing to risk is in the business's interest. Even more marginal businesses can still get access to finance. And finally, cost of administration. Clearly, meeting a business customer, doing an application assessment for finance, setting up the facility, providing the documentation, monitoring and controlling the facility, as well as providing regular information and revising facility, all carries a cost. So while banks may use credit and performance scoring tools, most will also require a judgment to be made by an experienced relationship manager. Smaller facilities tend to have a relatively higher administrative cost per pound lent than larger facilities, and not all of that cost may be recovered through fees. So small facilities tend to bear higher margins, even if the risk is comparable with larger lending. Further information on how prices are determined can be obtained from the Better Business Finance website at betterbusinessfinance.co.uk and look for the fact sheet on loan pricing. Much of that may have sounded rather technical, so here is an example which I hope will help. If a bank has 10 customers and the bank was to lend £100 to each of those customers and charged an interest rate of 10% per annum, this would give the bank an income of £10 per annum per customer. If 9 of those 10 customers each keeps to their commitments and pays the bank back £10, that particular bank will have an income of £90. However, if only one of those 10 customers defaults in the first month, then the bank will incur a £100 loss. So the net result is an overall loss to this particular bank of £10. Hopefully that gives you an illustration of the mechanics of the bank pricing. And clearly in this particular very simple example, that is purely an income of £10 that has not taken any consideration of the cost of funds, the cost of risk and capital, or the administration costs. Business plans. In this session, we'll have a look at business plans and who the business plan is actually for. Well, if 70% of businesses at any one time don't need to borrow, it can't be solely for the purposes of raising finance, although in many cases there are people who believe it is so. So, what else can it help you to do, and who should be interested in a business plan? Well, business owners can make the mistake of thinking that the plan is solely to obtain finance, but a good business plan can do much more. For example, it can help you to clearly identify and communicate what the business is all about, to bring together ideas and research in a structured format, to identify any further research that is required. A plan can help outline the strengths and weaknesses of the management team. It can help set for the business targets and objectives. It can provide a benchmark that enables the businesses to monitor the business performance effectively and regularly, and to mitigate issues and spot opportunities to leverage finances more effectively. And the business plan should provide evidence that the venture has potential. One of the key roles that mentors can play is to help business owners put together and shape business plans, because it enables them then to effectively help with the thinking process. The great advantage of a plan is that it does at least enable businesses to get these ideas on paper and to shape them and consider where they want to be in 2 or 3 or 5 years' time, and what steps they're going to take to get them to their chosen goals. So what sort of information should go into a business plan? Well, there's no sort of hard and fast rules, but a business plan would typically contain an overview of your business. This should summarise the key points of the plan, showing the highlights from each section and focusing on your competitive advantage, profit forecasts, and how much money you need and prospects for investors. I'd also expect to see details of the business's legal status, key personnel, aims and objectives. Each business structure has different benefits and drawbacks, so it is important to learn what each of them has to offer. Details of the products and services the business will provide. Essentially, what will the business do? Details of target customer characteristics and estimated numbers. Focus on a specific customer group. Think about the needs of these customers and how your product meets these needs, and back it up with research. An assessment of your competitors' strengths and weaknesses and how your business is different from the competition. Details of how you intend to market your business. So the real detailed information on how you will sell your product or service, how and where the business will operate, and finally, your financial requirements, including how much money is needed and when it's needed. And you will need to show what capital you need, any security you can offer lenders, how you plan to repay loans, sources of revenue and income, the prospects for investors or lenders, cash flow, profit and loss and sales forecasts for the next 3 or perhaps even 5 years, and the assumptions behind your forecasts and risks that might affect those figures. And I'd like to spend just a few minutes talking about that last point, the assumptions behind your forecasts and risks. It's very easy to write the plan and put in numbers which are actually not achievable. So it's so important to spend the time just questioning those assumptions behind those forecasts. Do you honestly believe that a new startup business in a similar industry, doing something very similar to other competitors in today's world, is going to see 20, 30, 40% growth in the first year? A lot of financiers will take some convincing that such a strong growth performance would be achievable. Certainly from experience, that with looking at many business plans, many are overly optimistic in terms of sales forecasts, and some will also underestimate the time it would take to achieve the level of sales that they're seeking to achieve. And this is very important from a cash flow perspective, because clearly, unless those revenue streams are available fairly quickly in accordance with the plan, it'll become increasingly difficult for the business to service the borrowing that has been suggested in the plan. So as much attention to the assumptions and conservatism is probably a good recommendation.